Welcome to the Retirement Classroom. Today's Masterclass tackles one of the most important and most overlooked topics in retirement planning, long-term care. The statistics are sobering. 70% of people over 65 will need some form of long-term care in their lifetime. The average cost of a private room in a nursing home now exceeds $110,000 per year, and Medicare covers almost none of it. Yet, the majority of retirees have no plan for how to pay for long-term care. By the end of this masterclass, you'll understand all your options, the costs involved, and how to build a plan that protects you without draining your retirement savings. Let's start by defining what long-term care actually is. Long-term care includes assistance with activities of daily living such as bathing, dressing, eating, transferring from bed to chair, toileting, and continence. It also includes care for cognitive impairment like Alzheimer's disease and dementia. Long-term care is not the same as medical care. It's custodial care, assistance with the basic tasks of daily life that you can no longer perform on your own. This distinction matters because Medicare is health insurance, not long-term care insurance. Medicare will cover skilled nursing care after a hospital stay for up to 100 days, and even then, only partially. It does not cover custodial care, assisted living, or extended nursing home stays. The costs of long-term care vary significantly by location and type of care. Let me give you the current national averages. Home health aid care averages about $61,000 per year for full-time assistance. An assisted living facility averages about $64,500 per year. A semi-private room in a nursing home averages approximately $94,000 per year. And a private room in a nursing home averages over $110,000 per year. In high-cost states like Connecticut, New Jersey, and New York, these numbers can be 30 to 50% higher. The average duration of a long-term care need is approximately 3 years, but 10 to 20% of people need care for more than 5 years. For Alzheimer's patients, the average duration is 4 to 8 years. This means a potential cost of $300,000 to over $800,000. Now let's talk about how to pay for long-term care. You essentially have 5 options, and the best approach for most people is a combination of several. Option 1, self-insure. This means paying out of pocket from your savings and investments. If you have a net worth of over $2 million, not counting your home, self-insuring may be a viable strategy. The risk is that a very long care need could still significantly deplete even a large portfolio. The advantage is you keep full control over your money and don't pay insurance premiums. If you go this route, earmark a specific portion of your portfolio, typically $200,000 to $400,000, as your long-term care reserve. Keep this amount in relatively liquid, conservative investments. Option 2, traditional long-term care insurance. This is a standalone insurance policy that pays for long-term care services when you need them. Premiums have increased dramatically over the past 20 years, as insurers underestimated how often and how long people would need care. Many insurers have left the market entirely. If you can find an affordable policy, the ideal time to purchase is between ages 55 and 65. After 65, premiums become very expensive, and if you have any significant health conditions, you may not qualify at all. A typical policy might cost $5,000 to $8,000 per year for a couple and provide 3 to 5 years of benefits with a daily limit of $200 to $300. Option 3, hybrid life insurance and long-term care policies. These have become the most popular option in recent years. A hybrid policy combines life insurance with long-term care benefits. You pay a single premium or fixed premiums for a set period, and in return, you get both a death benefit and the ability to access that benefit early if you need long-term care. The key advantages: premiums are guaranteed and will never increase, unlike traditional long-term care policies. If you never need long-term care, your beneficiaries still receive a death benefit. And some policies offer a return of premium option if you change your mind. A typical hybrid might work like this. You pay a one-time premium of $100,000. This provides a $300,000 long-term care benefit pool and a death benefit of approximately $150,000 if you never need care. This leverage, getting $3 of care benefit for every $1 of premium, is the primary appeal of hybrid policies. Option 4, Medicaid. Medicaid does cover long-term care, but only after you've spent down almost all of your assets. In most states, you must have less than $2,000 in countable assets, though a healthy spouse can keep additional assets and the family home. This means Medicaid is essentially the option of last resort. You must impoverish yourself first. Medicaid planning, which involves legally restructuring assets to qualify while preserving some wealth for your spouse, is a legitimate strategy but should be done with an elder law attorney at least 5 years before you might need care, due to the Medicaid look-back period. Option 5, veterans benefits. If you or your spouse served in the military, you may qualify for Veterans Aid and Attendance benefits, which can provide up to approximately $2,800 per month for a veteran with a dependent or over $2,100 for a surviving spouse. These benefits can be used for home care, assisted living, or nursing home care. Requirements include wartime service and demonstrated need for regular assistance with activities of daily living. Let me walk you through how to build a comprehensive long-term care plan. Step 1, assess your risk. Consider your family health history, your current health, and your gender. Women are statistically more likely to need long-term care and for longer durations than men, partly because they tend to outlive their spouses and don't have a caregiver at home. Step 2, calculate your potential cost exposure. Take the average cost in your area, multiply by 3 to 5 years. This gives you your estimated long-term care cost range. In a mid-cost area, that might be $250,000 to $500,000. Step 3, determine your current coverage, add up available family caregiving support, any existing insurance benefits, Social Security income that could fund care, pension income, and liquid assets you could dedicate. Step 4, identify the gap. The difference between your potential cost and your existing resources is your long-term care funding gap. This is what you need to fill with insurance, additional savings, or a combination. Step 5, choose your funding strategy. For most middle-class retirees, the optimal approach is a combination. Partial self-insurance covering the first 1 to 2 years of care, known as a self-insurance deductible, combined with a hybrid life insurance or long-term care policy covering years 2 through 5, plus maintaining Medicaid as a backstop for very extended care needs. There are several important tax considerations. Long-term care insurance premiums are partially tax deductible. The deductible amount increases with age. In 2025, a person over 70 can deduct up to $5,930 per year in long-term care insurance premiums as a medical expense, subject to the 7.5% of AGI threshold. Benefits received from a tax-qualified long-term care policy are generally tax-free up to a per diem limit of $400 per day in 2025. If you're considering using your HSA for long-term care insurance premiums, this is one of the most tax-efficient strategies available. HSA funds used to pay age-based long-term care insurance premiums are a qualified medical expense, making the premiums effectively triple tax-free. The HSA contribution was deductible, the growth was tax-free, and the withdrawal for LTC premiums is tax-free. Let me give you a comprehensive example. David and Karen are both 63. They have $1.5 million in retirement savings, $50,000 in combined Social Security, and no long-term care insurance. Their estimated long-term care cost in their area is $90,000 per year for assisted living and $120,000 per year for a nursing home. Their strategy? They purchase a hybrid life and long-term care policy for each spouse. David pays a one-time premium of $75,000 from his traditional IRA. This provides $225,000 in long-term care benefits and a $125,000 death benefit. Karen pays $75,000 for a similar policy. Total premium, $150,000. Total long-term care coverage, $450,000, enough for approximately 4 years of nursing home care. If neither needs care, their beneficiaries receive $250,000 in death benefits. They also earmark $100,000 in liquid savings as their self-insurance deductible for the first year of care. Their total long-term care plan covers approximately 5 years of care at $120,000 per year. 1 year self-insured plus 4 years covered by hybrid policies. Beyond 5 years, Medicaid would serve as their backstop. This comprehensive plan cost them $150,000 in premiums plus $100,000 earmarked, protecting the remaining $1.25 million in retirement assets from being depleted by long-term care costs. If you found this masterclass helpful, subscribe for more in-depth retirement planning education. And if you'd like help building a long-term care plan customized to your situation, check the link in the description for a free consultation. Class dismissed.
Hey, before you go, if you're serious about your retirement, we'd love to help. Scan the QR code on screen right now or visit the link in the description to book a completely free strategy session with a qualified professional. It only takes a couple minutes to fill out, and there's absolutely no obligation. Take the first step today. We'll see you in the next one.